If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with 5 dividend stocks you can buy and hold forever. If you're new, make sure to hit that subscribe button, hit that like button, comment down below. I greatly appreciate any and all support. It seriously helps out so much, and I cannot thank you enough for just doing those simple things. Now, the stonks we're going to be taking a look at. None of this is financial advice, by the way, just entertainment and educational purposes only. Stick with me. Let's see what we got going on here. We got Starbucks Corporation, we got Texas Roadhouse, Hershey Company, Tractor Supply, and Agree Realty Corporation. So I got 4 stocks and 1 REIT for you today. Very quickly, let's take a look through these, what makes them tick. Starbucks has an adjusted free cash flow yield of 2.57%, a dividend yield of 2.5%, and a payout ratio right at 65% in that sweet spot. It's off a recent high of 115 down to 91, so might be something you want to take a look at. Revenue's been growing at a rate of 8% over the last 10 years. Very nice. Free cash flow has been increasing slowly, 3.82% over the last 10 years. EPS has been growing. That's ridiculous, 88%. But you can see the trend up and to the right here. They do have a little bit of debt at $11.8 billion. Their EBITDA is $6.29 billion, so there's no issues there. I don't like companies that have three times their EBITDA or more in debt. And this definitely falls within the line of not that. Dividend's been increasing at a rate of 18.43% over the last 10 years. Very nice. This is just a nice little set of stairs here. And the shares outstanding, they are slowly but surely buying back shares, which you love to see this because that just means you're getting a bigger and bigger piece of the pie. And when it comes to return on capital employed, they had their little 2020 hiccup, but they're right back off to the races. This has been consistently above 20% for quite a while, and it's growing. They are opening up more stores, which is just perfect and expanding quickly. And I have a Starbucks in my town. That thing's just busy as a bee constantly. Love them. Next up's Texas Roadhouse. Free adjusted cash flow yield of 2.71%. It's got dividend yield 2.2%. Payout ratio 46.6%. Revenue's been growing at a rate of 12% over the last 10 years. Very nice. Free cash flow 15.8% over the last 10 years. Just up and to the right. EPS been growing right in line, 14.78% over the last 10 years. They have $50 million in debt. Their EBITDA is $460 million. They have more cash than debt on hand. Not an issue whatsoever. They could just pay off their debt if they wanted to. Dividend's been increasing at a rate of 16.44% over the last 10 years. Very nice. When it comes to shares outstanding, not too much going on here for the last 10 years. But here, as of late, they have been buying back some of those 3% over the last year. Very nice. And the return on capital employed minus the 2020 hiccup is been around 15%. There's your 15% line. So been above 15% for mostly the duration, which is very nice. The company average I think is around 10 to 12. Texas Roadhouse off the recent high of 117 down to 95. And I have personally been gobbling up some of these shares, especially below a hundo. I like it a lot. Next up, this is a big favorite of mine. I loved them at 220. I am in love with them below 200. Adjusted free cash flow yield 3.89%. Dividend yield 2.3%. Payout ratio 47.7%. It's Hershey. This is blowing my mind here. Recent high of 270 down to 199. What is going on? Over the last 10 years, 4.6% revenue growth. Here lately, they've accelerated, though. 13% over the last 2 years. Very, very nice. Got some free cash flow here. 8% over the last 10 years. Here lately, right at 20% over the last 2 years. Very, very nice. I like the company a lot. Make sure to do your own research. Don't just buy it because I like it. EPS been growing at a rate of 10.6% over the last 10 years. Comes to debt, they do have a little bit, $3 billion in debt. Their EBITDA is $2 billion. Again, issue. They could easily manage and pay down this debt if they wanted to. Dividend's been increasing at a rate of 9% over the last 10 years. Here lately, they've been increasing, though, 15% over the last 2 years. This is a company that they were starting to kind of like stall out with their growth, as you can see here. And then it's taken right back off, and I love it. I love it. Shares outstanding, there's not too much to talk about. They do a little bit here and a little bit there. Return on capital employed, 2020 was 19%. Oh no, it dropped to 19%. And then 20.3, 21.8, and it is just growing. I cannot brag enough about this company. I could do a whole video on Hershey just breaking down all the stuff I like about it. Next up, Tractor Supply, just free cash flow yield 2.7%, payout dividend yield 2.03, and a payout ratio right at 39. Off a recent high of 250, so down almost $50. This is another one I've been eyeballing. I used to hold it, and then I was trying to like move things around, but it has caught my eye yet again. Revenue's been increasing at a rate of 11.7% over the last 10 years. Free cash flow's been increasing at a rate of 9.98% over the last 10 years. All of these things are very nice. EPS 17.72% over the last 10 years. Debt, they have $814 million. Their EBITDA is $1.78 billion. Well, just no issue there yet again. They just pay it off. Dividends been increasing at a rate of 23% over the last 10 years. This is just walkers. Of course, they got this giant hike in here of almost 50. That's almost 100%. It's like 52 to 92. We'll do the math on that real quick. Calculator, come here. 52 to 92. So we went from 52 to 92. Yeah, they increased the dividend by 56%. That's awesome. Yeah, they've been growing it pretty reliably. EPS is growing, revenue's growing, free cash flow is growing. Share buybacks, very consistently been buying back shares at a rate of 2.5% over the last 10 years. You love to see it. And return on capital employed, 18% in 2019, 18.7 2020. Again, just growing. Love it. And lastly, we got a REIT. A lot of REITs are beaten up, but I like this one personally. This one's right in line with the S&P 500. If you look at the drip calculator, I really like Agreed Realty, and it pays monthly. It's so neat. REITs are different, though. Do your own research, but REITs are taxed differently than normal companies. This is down 21% on the year. It was around the 70s, so they're having a little bit of a rough time. Revenue's been increasing at a rate of 29%. Bonkers. Free cash flow is 32.8%. Bonkers. You don't really look at EPS growth when it comes to REITs. So they do have a lot of debt. Most your REITs are going to. They take out a lot of debt and they issue a lot of shares for acquisitions and stuff and buying properties. The dividend's been increasing at a rate right at 5.8% over the last 2 years. Their last hike was right at 4%. So you might be looking at this and being like, what's going on? There's a big drop. No, they were paying quarterly, and then they decided they want to pay monthly. So, I mean, I'm about it. I think it's neat. But again, yeah, you're going to see shares outstanding and the debt rising. So that's just how REITs do. But there's 5 pretty good companies that you might want to look into. I like them. I think these are great forever, buy and hold forevers. And yeah, make sure to hit that like and subscribe button for more. I greatly appreciate it. And until next time, see yous.